the market continues to be very strong, as we know, and it's up another 4% or so this month. A lot of this is being driven by the liquidity in the Federal Reserve and the stimulus. But the most important thing going on in the world right now is what the U.S. Congressional, the Office of the Budget calls rapid shifts, and what we call the velocity of creative destruction. There's a lot of money also coming in stimulus, and next month we're going to talk about macroeconomic top-down bulls versus bears stuff. But we do want to just comment now on what Janet Yellen said on Meet the Press on the weekend. And Janet Yellen, of course, was the head of the Federal Reserve Bank, which is owned by banks, which is a nonprofit organization which lends money to banks and sets interest rate policy to try and balance out employment and inflation. And so Janet Yellen, being part of the Federal Reserve Bank, is now the Secretary of the Treasury, and so she is working directly with President Joe Biden to do things like manage the IRS, which taxes and brings in money and spends it on things like this $1,400 stimulus check that just went out. So on a macroeconomic sense, what we're hearing from Janet Yellen on the weekend is that she sees 1.6 trillion in additional government spending. Now, we've broken that down. We don't see the 1.6 trillion, but the first CARES Act that came out to support after the pandemic was through President Trump, and that was 2.3 trillion. So let's take a perspective. The U.S. economy is about 23 trillion, and U.S. government debt is about 23 trillion. And the first stimulus package from Donald Trump was about 10% of that. So it was 2.3 trillion. The CARES Act was the first stimulus, which extended unemployment, et cetera. The second plan is called the Association of whatever.
The Budget Consolidation.
The Budget Consolidation Act, which was 2.1 trillion in 2.2 trillion, which was additional support, and that was in December. And then we had a pass in March where President Biden is borrowing 1.9 trillion, and that's gone out in this $1,400 checks. So that adds up to 6.5. Now, there's an additional bill before Congress to raise an additional, say, 4.5 trillion. 4.5 trillion, and that's going to go into spending money on infrastructure. So that's going to be roads and tunnels and bridges and internet, and then it'll also go into healthcare, and then into education and into childcare. So this additional expenditure of, let's call it 4.5 trillion, is another 20% of the GDP, but it's coming over a period of time. The first 6 was spent, 6.5 was spent. The next 4.5 will be spent over a number of years. And the real question to the Treasury Secretary is, how are you going to pay for it? And the answer is that, this is the subject for next month, but I want to give you a prelude that what the plan is to raise taxes. So Donald Trump cut the corporate tax rate to try and encourage companies to move to the U.S. It's a government incentive to do business in the U.S. to 21%. And Janet Yellen says they're going to raise the corporate taxes, but they're going to go around the world and try and get other countries around the world to agree that they should also raise corporate taxes. Because the problem is that it's a race to the bottom. Every country is incentivized to provide zero corporate taxes because corporations can leave and tax the individual who can't leave through either their income or their expenditures. So what Yellen wants to do is go around the world and say, hey, everybody, let's all agree to raise taxes. That sounds like game theory, right? And then the second thing that she wants to do is tax the rich. So the idea is that if somebody makes more than $400,000, then they would be subject to dividend capital gains tax. And if they make more than $1 million, that they would be subject to 39.5% tax rate on dividends and capital gains. So it's tax the rich, and it is the biggest. So it's going in the opposite direction of Ronald Reagan, who said, the government is here to help you is the worst thing you've ever heard, right? So I think something like that. But he was all about reducing the size of government, and now we're looking at growing the size of government to bigger than it's ever been before. So the government is there to try to run the economy, and Our view, I think, is that, we want to make investments for you that accommodate whatever policies are going on, but I'm more of a free market guy than that. So my personal opinion shouldn't really matter whether it's the right thing to do or not. What should matter is that we can make investments that, well, as my father used to say, just admit to the reality of things the way they are. Okay? I used to say more funny sense of humor than that. But the market up 4%, earnings estimates up 2.3% as we engage in a recovery in the U.S. Now, one thing that I'll point out again in this presentation is that the pandemic has been great for internet-based stocks. Companies like Microsoft and Apple and Zoom, et cetera, have all been able to benefit from the velocity of creative destruction. But interestingly, they're also benefiting from the recovery, so they seem to benefit in either scenario. So when we're seeing this increase in earnings estimates, we're seeing it not only for the reopening trade, or the subset of that, the reflation trade, where we're seeing prices for lumber and plastic and oil and trucks going up, and we're seeing increase in earnings for a whole range of those cyclical industries. We're also seeing increases for the big tech companies, the top 5. Now, someone help me out here. I said that the top 5 were 19% of the S&P 500 in February 19,
Yeah.
and then where did it go to? Do you know where it is?
23%.
It's about 23% now. So the top 5 being Facebook, Amazon, Apple, Microsoft, and Google.
Yes.
And Google A and B. Right. So they're almost 25% of the S&P 500, which is a bigger concentration than I know has ever been. I know Exxon was gigantic in the early 1900s, and then the Nifty 50, but I think this concentration is unprecedented. Question? No. So the reopening trade and its subset, the reflation trade, is, well, you can call the reopening trade hotels and restaurants. The reflation trade are commodities like lumber and plastics and polyurethane and the like. Particularly telling winners. Okay, so Facebook, Amazon, Google, Zoom are winners in the fall because of their velocity of creators, and they're also benefiting from the recovery, which says they're just great companies, but they're getting so big. When does Elizabeth start to try to get control of these companies? Eventually, that's going to happen. Elizabeth Warren. Steve has a very strong personal view on Elizabeth Warren, don't you?
I do. Yes, I think she's a disaster. Senator from Massachusetts, very hard on business, in particular financials, but it's really mostly grandstanding more than anything.
But she should have power now.
Yeah, she does. Yeah, head of the Senate Finance Committee.
And if you still think she's American Indian?
So, to get into Harvard, she claimed that she had American Indian or Native American ancestry, and it turns out she doesn't really. No more than me, to most Americans. And so Donald Trump called her Pocahontas all the time when referring to her, which ticked a lot of people off.
Yeah, Pocahontas is an American native who married Sir Walter Raleigh, and he took her back to London and had this beautiful wife, but she didn't really adapt, did she?
No, she died young.
Yeah.
Because of it.
Here are the biggest movers for the market. Dish. Now, we talked about Dish last month, and I want to go into this again, but just imagine you're out on a farm and you can see the satellite dish, and these guys are selling pay TV services through that dish. It's good for remote access, and they're more rural. They've got 21 million subscribers. They're big and becoming obsolete. Okay, so why are they up? Because they are shifting to 5G. They're the fastest adopters of 5G. They're going to roll out. Now, 5G, I think of as you need a lot of little towers all over the center city stuff. And I don't see the mix between going from rural dishes to inner city towers, but they are making the transition very well. Now, we always get the question from Tim here, why is Harley Davidson up, right? So, Harley Davidson makes motorcycles, and we'll go into this in a little more detail, but I'll just give a brief. They are turning the company around. So the new CEO has been able to overcome some tariffs in the UK by producing in Thailand and delivering. But the other thing they're doing is they're going into the electronic vehicle space. And their EV push, I was joking around, we joke around since you were, I said, well, is it going to come with a sound system? Because Harleys are known for that deep guttural, right? So is their EV vehicle going to come with a sound system, right? But probably not. It'll probably be as quiet. NCR is National Cash Register Company. They used to sell cash registers, and now they sell the point of sale machines, and they're having a good result. United Parcel Service is a great company, and you would expect during the pandemic to see that Amazon is buying planes and doing their own delivery and drones. You've got FedEx with more freight on air through their Asian hub, whereas United Parcel Service is more about domestic stuff and peeing in bottles. Everyone know the peeing in bottles story? Who got in trouble for that? Amazon? Oh yeah, so some of their workers had to pee in bottles and they apologized because they didn't have enough time for a restroom break. I mean, sorry. Okay, Louisiana Pacific, they're on the Pacific side and the Louisiana side. So think of the name being they've got forests, they grow trees, they cut the trees down, and the lumber sells in 2x4s at Lowe's and at Home Depot, and people use it to build houses or whatever. So Louisiana Pacific, what we're seeing, and I'll go into more detail, but there's a big surge in lumber prices as demand for building houses keeps pulling through during this pandemic. We talked about what we call the K curve, right? And we say Black lives don't matter, right? So don't be offended by it. But it says that during the pandemic, rich got richer and poor got poorer. And that even though there was a lot of bad stuff going on for Black people in America, losing jobs and everything, they don't matter to the stock market. They matter to me as people. They don't matter to the stock market. So when I say Black lives don't matter, I mean not offensive racist, right? I'm saying that the stock market doesn't react to that. You guys, am I being careful?
Controversial.
I'm not offended. You know what I'm saying. Okay.
Very nuanced point there.
So Intuitive Surgical is benefiting from, this is the reopening trade. So in case anyone hasn't, I'm sure everybody's noticed, I can now stand on one leg. I have no pain. I've had the hip replacement. I feel great. So, but the elective surgeries are opened up, and I'm very happy with my new hip. But that is because not only Intuitive Surgical, but Medtronic, which we own, and Edwards, which is more of a valve company, and Boston Scientific, which is more of a stent company, and Medtronic, which is a combination of both, all three with. So we're seeing lots of opening up, and we're seeing benefits here for Intuitive and Edwards and Boston Scientific and Medtronic just out of that list there. So we're seeing a big run. Now, last month, remember, we saw a big run up in drug distribution companies. So AmerisourceBergen, Cardinal Health, and McKesson were all up substantially. These companies are wholesale pharmaceutical distribution companies. So they'll buy the drugs from the drug company and they'll take it out to the hospital and sell it at the hospital, right? And they were selling, you got it, opioids. I was on opioids for a week and I hated them, but they give out this OxyContin, they get people addicted, and there was a big scandal and there's a big settlement going on, and the trial starts today. The trial might start today. And so these stocks went up substantially last month on the hopes that there would be a settlement at the court doorsteps. So, but this month they were flat. So last month we were talking a lot about drug distribution. And this month we're talking about the device companies having a big run up. On the downside, unfortunately, Boeing is down, but who's going to talk about Boeing later? Chris will. And Volkswagen, they're now the biggest car company in the world, and they went up like 50% the month before, and they're retracing from that 50% gain as they really engage in that electronic vehicle space. eBay had some negative results, which was surprising. You would think they would do better during the pandemic. I need to serve that. Richard.
He's gone.
I had my COVID shot. I had my COVID. Anyone here had their COVID? Just a few? Yeah, and no blood clots. Out of the dust. So let me kind of move forward here. We've seen some retracement in U.S. Steel and Cleveland Cliffs, Baker Hughes and Occidental. So some of these stocks that are the big cyclical rotation companies did very well last month. They ran up. They took a breather this month. They could continue on, and we expect them to continue on. The reopening and the reflation trade is strong, and inflation is strong. The question becomes, is inflation, and we said this in February, is inflation going to be very heavy now because the $1,400 checks are coming out, and then cool off? So we're going to get a bump on the 1,400, and then a fall off, and how sustainable is the 1,400? And we're seeing that now. So we got a bump up last month, and the question is whether that's sustainable. So let's go through to some of the biggest changes in earnings estimates. Air China down, indicating China may be weaker than they might be saying. I don't know. Maybe we've got a view on that, right? Barrick Gold down, Shopify down, Alibaba down, but not a lot really down here. Boeing and Raytheon down, and Steve will, Chris will talk about Raytheon. On the upside side, Shopify is kind of a hard thing to put in there. Wait, Spotify and Shopify, don't get these two confused. They're very similar, right? So one of them does shops and the other one does music, right? So shops online. What do you want to just explain that so people can listen to somebody else for a second, the difference between Shopify and Spotify?
Sure. Well, I don't invite Richard to chime in if you like, but Shopify is a payment platform that facilitates e-commerce, and Spotify is a music and other entertainment app predominantly, which enables you to listen to music, but they're especially focused on apps and some other podcasts and other unique listening content in more recent times to try and distinguish their offering. But interestingly, Spotify was one of the largest decliners for the stocks this month, yet the earnings estimates are up very substantially. And the earnings, it's a high growth, marginally profitable business at the moment. So any small absolute increase in the profit estimates translate to a very big percentage increase. But the stock, I think, was down mainly due to the competitive moves from Apple to really bolster their podcast offering.
Spotify earnings estimates are up 60% from almost 0 to almost 1. So the percentage change is less important here than the actual change. Did you mention Viacom? We will. Cam, good to see you there, Cam. Who wants to talk about Viacom? Viacom, okay, so Viacom went from $30 to $100. And this big run up was largely because a family office, not a hedge fund, called Archegos. I call them arch egos because they're like arch rivals, right? So arch egos, as I call them, Cam, were buying using swaps, so they could get 4 or 5 times leverage to buy into a number of different companies. Now, Viacom got up to what I would consider a reasonable valuation, 20 times earnings. And then this family office was caught in the downdraft. So when we got to the top of the market, Viacom decided to issue some stock. When they issued some stock, that created some liquidity in the stock. And then suddenly there was less demand and more liquidity, and the stock price started to fall, and arch egos started to have to be sold out in margin calls. And there was very aggressive margin call selling because big Wall Street firms had sold swaps. So that would be Goldman Sachs, Morgan Stanley, Credit Suisse, UBS, a number of them, decided that they had to issue margin calls against Archegos, and then as a result of those margin calls, there was very aggressive selling. Now, I think this event demonstrates that number one, the bill put through after the global financial crisis didn't work. Okay, and Barney Frank and Dodd-Frank didn't work. It was supposed to make swaps transparent, and I think the SEC is going to get their butts kicked, Cam, very hard by Congress, and is bad news for the SEC. Okay, now the reason we've seen Viacom falling is because of these margin calls forcing the stock to get sold down. So you had artificial buying, now you have some artificial selling, and the stock has been particularly volatile. And it went, let's say, to overvalued, and we didn't sell it. And now we would say it's back to undervalued, having fallen again this month. It fell last month more, but it's still well ahead of where it was 6 months ago. Cam, thanks for asking.
Yeah, it's about 400% above where it was March 2020. So we've given some back, but it looks like it's now a more normal trading situation because it's highly unusual what's going on in the stock for about a month and a half.
Now, Cam, while I have your attention, when I mention Sony, what do you think of?
I don't think you can respond.
Is he going to send me a message? Okay,
PlayStation.
what do you think of when I say Sony? What? Electronics, yeah. So TVs, stereos, but they're most successful. So TV, stereos, Japanese manufacturing, and these guys are dependent on product or raw materials coming through Huawei. So they're having channel problems. So you see here, earnings estimates are up. That's because they're a March year end. So the earnings estimates are actually down, but we've rolled forward to March 2023. So that's looking out one more year. But when you look over year, month over month, it fell. So this is a roll forward. They are doing very well in the gaming business. We'll talk a little bit more about Microsoft and their gaming business and their new platform. But I think that it's nuts that we had Activision Blizzard. We own Electronic Arts. There's Take-Two Interactive. There's a lot of M&A going on in the gaming business. I tend to think of these companies as providing, a toy box for young gamblers, and eventually they'll end up in Las Vegas or Macau. But and I have ethical dilemmas with these companies. But the Sony PlayStation is their successful point in the market right now, whereas the other sectors are not doing so well. So Sony's good. Harley Davidson, good increase in earnings estimates. United Parcel Service, good earnings increase. ASML, they make semiconductor equipment, and semiconductors mostly going into the Apple phone. Shortage in chips, driving their prices up, helping them. Dow Chemical, plastics. So the difference between plastics and polyurethane is foams and coatings and things like that. But polyurethanes is a bit different than plastic, but they're benefiting not only from plastics or polyurethanes, which if you do a regression analysis, you can chart demand versus the auto industry or the construction industry. So it's really going into auto and construction, and the profit is dependent on the price of oil and what the capacity utilization rates are at their plants, and who's going to build a new plant to increase capacity. So we'll talk a little bit about Dow and the German polyurethane company. Cam, no comment on Sony? Well, I got you going. No, banks. Okay, so who's going to talk about banks?
Yeah.
Or should I do banks and you do Goldman Sachs?
Yeah.
I think it's better to have a change in voice, because should I change my voice? Maybe I'll go to it. Maybe I'll do the Elizabeth. What's her name?
Why don't you do Janet Yellen?
Why don't I do Elizabeth Holmes?
Janet Yellen
No, I'll do Elizabeth Holmes. I'll do Elizabeth Holmes. Banks. Does anyone know who Elizabeth Holmes is? So she started this startup company in Silicon Valley, which was doing blood testing. And she got George Shultz and all these great people to invest, but it was all a great big scam. But Elizabeth Holmes is now going to jail for running this great big scam. But she would imitate Steve Jobs, and she would wear the turtlenecks, and then she would put on this fake voice. So she'd go around talking with this deep, manly voice all the time. And but eventually she got caught out and she's going to jail now. So so I'm not going to do the Elizabeth Holmes, but you should know who she is. There's a good movie on Netflix or Amazon called The Inventor, because she just invented things. So it's funny, but it's not funny. But
But we suspect that was sort of like her tell.
was
when
her
she
new
was
voice.
not telling the truth. That was sort of this.
What a
persona
piece of
she
work.
got.
Okay, Wells Fargo was up 14%, and they fared the best after the global financial crisis because they didn't really get in all that trouble that the other banks got into during the global financial crisis. But because they kind of got away with it, they ended up doing things that were bad, like they opened a lot of accounts for people without permission, and then they charged them money. So imagine, when you account your name, you didn't sign up for it, you're getting charged fees. And this was a rampant problem within Wells Fargo. So they ended up having to control their balance sheet and slow down. And now they're out of that. And now they're starting to do better again. So they had a later cycle compliance visit from the SEC, who deserves their own compliance visit. But they're now recovering. Banks reported net interest income balances for two reasons. Okay, they're lower. Their net interest income is lower because interest rates are lower and loan balances are lower. So remember, when we went into the global financial crisis, when we went into the pandemic, a year ago, we were talking about banks taking bad debts, writing off bad debts. We're going into a recession. Banks are going to write off loans. We had a lot of write-offs. That was a big component of what's going on. Now the component is how big are the balance sheets. So what we see now is Bank of America's loan book down 14%. Citigroup's loan book down by 10%. Wells Fargo loan book down, and JP Morgan's loan book falling. So when you have low interest rate and a lower loan book, you have lower net interest margins. So now they're still making, all the money's being made right now on trading and investment banking, which is the virtuous cycle that we've written about before. And so I'll let Steve talk about, we're in the right place with Goldman Sachs. It's doing very well. They're exposed to the investment banking and the trading that is benefiting from the Federal Reserve repurchasing programs. So Chris is going to talk about Goldman Sachs, which we're very happy with.
Yeah, thank you. So the M&A activity on a rolling 12 months is running at about 12% ahead of the prior 12 months. And I mean, if you consider the unique time that we had during the worst of the pandemic, and that M&A is still that much ahead, and especially ahead in more recent months and quarters, we're positioned well, we think, with Goldman Sachs. They are consistently one of the leading M&A advisory firms, pretty consistently have about a 20 to 22% market share. The first quarter results were terrific, and I think that really helped dispel some investors' concerns that have been held for about the last, through much of the pandemic, the worst of the pandemic. The concern has been that, sure, the heightened volatility is generating bumper revenue and profits during this period, but is it sustainable? And the first quarter results demonstrated that it looks like they are. And so while the stock language during the worst of the pandemic, it's really been catalyzed higher after more recent quarterly results. The profit and revenue numbers for the quarter were 32% and more than 100% ahead of a year ago, and both more than 50% higher than the previous quarter, fourth quarter. And I think the Archegos experience, Goldman Sachs' experience, where there was no material impact to their financials, really serves to demonstrate their best-in-breed investment banking and risk management credentials. They're just executing extremely well.
I think we should just default to using the same name. I think we should call it Arch Egos, because I think helps.
Because Wang maybe had an ego, but no longer.
Yeah, well, they're Arch Egos, right? I mean, anyway, let's just stay consistent with the name, because a lot of people call them different things.
Yeah, so the stock's done well. It's trading at 9.9 times earnings and a decent premium to book value now, at 142% of book value.
So they got out. Okay, they sold. They had the margin calls. They sold out. They didn't lose any. Who lost the money? Nomura?
Credit Suisse.
Okay, they did not. And what were the rumors on Wall Street?
The rumor is that is this the room you're referring to, where
Credit
Credit
Suisse is
Suisse
going
and the
around
other
asking
banks?
everybody to.
Yeah, it was another game theory situation where apparently the risk departments tried to coordinate the divestment of these very large and concentrated stock holdings, about 10 stocks. And I suppose Goldman Sachs.
Yeah, so,
Yes.
so Goldman
They got
Sachs is
access.
going, oh, yes, Credit Suisse, you would like us to coordinate as they're pushing sell on the,
Yeah.
on the keyboard, right? That's trading, right? Coca-Cola, who's
Coca-Cola reported great earnings. They've managed this COVID period very well. About 50% of Coke sales come from venues and events. And so those sales dried up during the COVID period. And the company had to focus on cost cutting and hedging over the last 9 months. But in this last quarter, they handily beat on an earnings per share basis. Revenue was up 6% year over year to $9 billion versus the estimate of $8.7 billion. I think the key takeaway from the Coke call really was management's guidance around costs. And I think this speaks to potential inflation down the track. Because while we're not seeing inflation in consumer prices, we are seeing inflation in purchasing prices, or rather producer prices, from inputs going into things like Coke cans and syrup. So they're seeing producer prices increase that they've been able to manage this year through hedging practices, but they think that it's going to be more challenging in 2022. So the expectation is that input costs are going to continue to rise, and ultimately those producer price increases will feed through to consumer price increases, and we should see some inflation well above the 2% target level. But the Fed has said they are not concerned about inflation going to 3 or 4% over the next couple of years, given the under target we've been for about the last 12 years. We have not reached that 2% target level since really 2010.
Dish estimates are up, even though there's a secular decline, and there's what they call cord cutting. So we have a reduction in the amount being paid to Disney and Viacom. So they're setting up direct streaming, and Dish is trying to make money now out of converting to 5G. There's a good survey on Bloomberg that we can send to you showing who is spending money on 5G and who's really out in the front of this stuff. And it is Dish and Qualcomm. So we're happy with our Qualcomm investment. There's an agreement with Amazon to build out 5G for cloud and phones. And so Dish is completely changing their whole business model. I did send an email to Viacom, and I said, why don't you call Amazon, call Dish, and see if you can do a deal with them? But he hasn't got back to me. I used to write emails to this guy at Radio Shack, and I said, why don't you sell coffee? Really, right? Why don't you just give away free coffee? But he didn't take my advice, and Radio Shack is no more, right? Yeah. So
Starbucks is doing well.
And Starbucks is doing well, but who am I, right? Okay, Sony warned about headwinds for electronics. They've got a shortage of components because of the Huawei sanctions. We rolled forward to a new year. Microsoft is gaining market share with their Game Pass. So Game Pass is a device agnostic system where you can log into a bunch of different games and then you just buy the one pass, and it's console agnostic, as we say. It's a subscription-based model, and that's growing. And Sony hasn't got there yet. So at least Microsoft is, unlike Apple, which would say everything has to be captured onto our phone, it has to be an approved app. Microsoft is an open system, right? And they're opening up on gaming.
Viacom, there's really nothing more to add. They'll report on the 6th, so we'll get a report out tomorrow or Friday. But in spite of the enormous volatility in stock, there has not been any change to earnings estimates. What we and investors are going to be focused on is progress in their streaming service, which we suspect they probably had some. If you look at AT&T's results last week, they had very good subscriber growth in their HBO Plus offering, and so I think that bodes well for Paramount Plus, which launched in the last 2 months. So we'll get more color on that. But there's really nothing more to add besides, the implosion one. I call it archegos.
Yeah, but
Because
we're all
it's
gonna agree
Greek.
to call it arch egos,
Okay.
right?
It
But
means,
I just want to
it's
call it
Greek.
arch
Okay,
egos.
we'll
It's
call it-
like they're arch enemies.
that would be, okay, we'll call it archegos, but it's Greek and it means leadership, which is maybe ironic.
Which is an oxymoron.
Well, I don't know. Yeah, so we'll get the report out tomorrow, but no change to earnings estimates. We're focused on streaming.
I sent Bob an email. I gave him the phone numbers for Amazon.
Electronic arts, so similarly, we haven't had results yet. Only 6 of our relative value portfolio holdings have reported earnings, but imminently Electronic Arts will report. If there's any sort of preview of the results, we had Activision Blizzard, one of their major competitors, report last night, and they're seeing continued momentum in their Call of Duty and World of Warcraft games. So continued momentum has been cause for them to raise their revenue and profit guidance. And to be honest, a lot of these trends adopting digital entertainment through COVID have proven, shopping, other things, have proven extremely persistent even as economies reopen. So I think Electronic Arts, that bodes well for their result. Viatris also reports next week. It's a similar story to Viacom in that the catalyst has been a combination merger, which occurred towards the end of last year, and now we'll look for management to execute against the rationale for that merger, which are cost and revenue synergies, and especially appealing in the current low interest rate environment, will be the initiation of a dividend. They've always broadcast their intention to pay out a decent percentage of free cash flow as dividend to shareholders. But also, like Viacom CDS, the stock has really languished at a level that would suggest the company's going out of business, less than 4 times earnings, which is
We're losing
just
money on
extraordinary.
this. Yeah, it's not good, but we're losing money. Chris, you're still up on Amazon. Oh,
Go. Amgen fell slightly after disappointing earnings. They're actually being still impacted by COVID. So a lot of customers for their drugs need to first be diagnosed with an ailment. And so the new diagnoses have been delayed. And overall, that results in a 4% decline in revenue. However, again, as just like elective surgeries will resume, people will return to the healthcare professionals, and those diagnoses will resume and translate to revenue recovery. Amgen have maintained their full year revenue and profit guidance. This is the second time we've invested in this stock as a relatively short-term trade. It's proven volatile and it's proven profitable. I think we're about 10% away from our short-term target price.
So devices performed very well this month. In the high-end, high-margin, high-expensive end of this market, you have Intuitive Surgical, and we invested in that, and we made a really, really great return. But minimally invasive surgery is the way to go. You have less invasion. My hip replacement involved some pointed things and one cut, but this minimally invasive stuff reduces the trauma and increases the recovery time. And Intuitive Surgical originally was building this to do robotic surgery on the battlefield for soldiers, where the doctor could operate from anywhere and perform surgery on the battlefield. Then Edwards Life Sciences really specializes in the valve. So your aortic valve can need to be replaced when it gets pushed through. And Edwards makes very high profit margins and good growth. And their market cap is about $60 billion. So their market cap of $60 billion is the same as Boston Scientific. Think of Edwards as being valves and Boston Scientific as being more about stents. So Boston Scientific doesn't have as high profit margins, but they have twice the sales of Edwards. So So Edwards has half the sales and double the margin, so they have the same market cap of about 60. They're both worth about 60. But Boston doesn't have as high profit margins. And then they're all in highly regulated industries. They're all benefiting from this recovery, this post-COVID trade of people getting back in and getting their surgeries done. My surgery was delayed. I mean, just from a personal point of view, it got done. I see this happening in real life. So both of these companies, all three of these companies, about 60, just under 60, about 55, 58% US dominated sales. That is going to go through Medicare and Medicaid, highly dependent on the government funding. The offshore business, similar, going to depend on the European regulatory environment to pay for things and insurance. So highly exposed to regulations and highly exposed to, like, you could get a recall on a product and this stock gets smacked, right? But we've seen stocks get smacked on a recall. So for the price for growth, we would rather own more diversified investment in Medtronic, which doesn't have a market cap of 60, but about 180, 3 times the market cap. And they do minimally invasive, they do valves, they do stents, and they do beds. They do a bunch of stuff. So it's a much more diversified exposure into the device market.
The world's largest implantable biomedical device business. They report earnings towards the end of the month. What we've seen at Medtronic and other device businesses is a lot of inventory stocking at customers. So consumables and instruments that are used to install or perform surgeries. And that's a strong leading indicator of the expectation of those customers for the resumption of especially elective surgery. So that should be a factor in the results. And I mean, the consumables and instruments last quarter were a record. And then the more recent result from their medical device peers have illustrated that trend to continue.
Thumbs up, Kelly. You want to do ours?
I'll let you take
You want to take it? Okay. Tesla is killing it. And the thing I want to point out is we had somebody here who was very interested in this a year ago. I said, don't think of Tesla as an auto company. Think of them as an energy storage company. So if you can load your battery home at night when power is cheap, and then drive the car into the office and then unload the battery in the office, you can sell your power. So think of it as a load balancing company with an auto company attached to it. It's like saying General Motors or Ford are finance companies that make no money out of making cars, but they make a profit out of the loans that they give people to buy the cars. So Ford and General Motors don't make money on cars, they make money on lending. Tesla makes the money, well, their end game is power management. So we did see power management increase to 7.3% of sales. Biden is pushing for the whole EV and emissions reduction and any carbon producing cars to go. Harley Davidson, they have a new CEO who's really turning the company around, doing a great job. So there should be a lot more upside in Harley Davidson. They want to make their electronic vehicles business a separate unit, which makes sense, unless, as I say, you add a big sound box to the EV because they're so quiet, right? God, I can't
It's
imagine.
actually a problem in China, they say. These silent running scooters and cars are hitting people because
They went through that in the
pedestrians can't
States already, you know? I mean, one of the first complaints about Tesla was, you can't hear it coming.
that's true.
But so I added a sound box to it.
Yeah, that's what they should do.
Yeah. I mean, when
So I
I
suspect Harley will put in their patented
I
sound.
mean, I'm sorry for all you people that pass on my motorcycle, but I lean on my horn all the time because I want you to know I'm there, right? So I do. I'm more by you know. If you guys see me riding on a motorcycle, you can probably hear me leaning on my horn. They've managed this this tariff issue in the UK, in the European Union, by delivering product from Thailand. So really good shift in supply from one zone to another as they face regulatory issues in Europe. At Fangs, oh, can someone else do this? Okay, there's this guy Oliver Busson, and I met him when I was deep into my whole blockchain business, and that's now on hold, but we can talk about that later. But he was head of blockchain for UBS, and now he's an independent consultant. And he put out this report where he said the 10 biggest big things are in cloud. So, and I'll run through them kind of fast, but it's important to understand Salesforce annual run rate of 2 billion. Google is going into artificial intelligence and machine learning. Oracle already has 100,000 industry cloud customers, 16 million users in 120 countries. These are the most important things going on in cloud. SAP, huge commitment to industry networks. So what's happening now is they're siloing by industry. So the big message here is the whole cloud solutions being siloed. Infor Enterprises, something I had never heard of, a private company in New York, is really running up the run rate of about $1 billion, doing very well. Microsoft, industry focus groups. So again, siloing by industry. And IBM saying the same thing, industry specific solutions. ServiceNow, they're talking about the need to be industry focused. And Workday, beautifully, let me see, the framework is beautiful for vertical markets. So instead of industries, verticals, I don't really know what he's talking about there, but Amazon and Amazon Web Services as they roll out to different industries. So what we're seeing now is a big push by industry for different cloud solutions. It seems to me, you put stuff on the cloud and it goes to a computer in a data center that's run by Cisco or Facebook or Amazon. And if it goes into a data center, why do you need industry specific? So if you're giving somebody a bunch of remote storage, then the interface with that, I don't get why cloud is industry specific. It seems that the app layer is industry specific, but they're talking about, everybody's talking about the cloud service being industry specific. Okay. Alphabet.
Tremendous sales, record sales.
Let's just pause for questions. I mean,
Oh, sure.
in my voice,
Yes.
Can we get some
Please.
conversation going?
Any questions, Gary?
Thanks. I found the Viacom one interesting. So that was purely on swaps. That wasn't a result of short selling.
Oh, well,
It went up on leverage buying, and it went down on a margin call.
so they achieved Archegos, achieved their exposure through these total return swaps that essentially saw the large banks who were the counterparties to Archegos buying up the shares so that they would hedge their exposure of the 10 stocks that we wanted a concentrated position in. And as a result, Archegos had control of about 25% of the outstanding shares of Viacom. So when Viacom announced that they were going to issue some stock, it diluted the shares and people started selling. And so there were some short sellers involved, which triggered this negative feedback loop that triggered more margin calls. And then the counterparties sold down almost all of their holdings within 2.5 days. So
that's sort of very different from the GameStop scenario where they were trying to force the short sellers.
yeah, it wasn't so much driven by short sellers. It was driven by a margin call that was precipitated initially by this stock issue that Viacom had. But in the course of about 3 days, Archegos lost $20, $30, basically all of their money. Plus an extra $10 billion that the banks had to write off.
Let me just add something here, Steve. But when we look at the value of a stock, there are 4 things that move a stock price. Okay? The first one is earnings. You make more money, the stock goes up. Okay? The second one is interest rates. When interest rates come down, stocks are more attractive and the price earnings ratios go up. So interest rates impact the overall market price earnings ratios. One of the really important things is risk. So if a company has predictable earnings, it's worth more than a company that does not have predictable earnings. Okay? So the 4 things that move markets are the earnings, the interest rates, and the risks attached to those forecasts here. The 4th thing is liquidity. And if a stock is a private company that doesn't trade on the exchange and you can't get in and out, it's not worth as much as an Apple or a Microsoft where you can get in and out. The problem with Viacom is the liquidity, because they are majority of the stock is owned by Sherry Redstone. So you've got all this stock locked up and you have less liquidity and you have more volatility because of the lockup situation with the family. Now, if it didn't have so much locked up, the stock wouldn't have been so volatile.
That's true. Yeah, the Redstones control about 80% of the voting stock. So that is a component of this.
But already, why did they dilute the stock? Because the stock was going up, right?
Well, that's
Because-
why. That's
Take
why.
advantage of the strength.
It was $100 per share, and they could issue, they could raise equity capital at an elevated level, the highest it had been in years. So they took advantage of that, and they had no idea that these swaps were in place. Management at Viacom didn't. There was no expectation that it would precipitate this sort of, sell-off. It's quite extraordinary, really.
So a thinly traded stock is going to be more volatile, and we've seen it run up and come down, but fundamentally we like it.
Yeah, it's about 6 or 7 times earnings again, which is pretty good value in the entertainment media space. So to Alphabet, Blockbuster results 34% sales growth, really driven by this, under the post-COVID world. Where during COVID, we saw a huge shift of consumer behavior to online sales, and there's still a lot of runway. In the U.S., about 20% of total retail sales come from online e-commerce platforms. So there's a lot of growth potential still in that e-commerce online sales space. So any business in that space should see a lot of runway for growth, we think. Earnings per share grew 162% year over year, just totally blowing the estimates out of the park. $26.29 in total earnings per share versus a $15.71 estimate. 49% growth in YouTube and 46% growth in their cloud services. So Alphabet is number 3 in cloud services, behind number 1 Amazon and number 2 Microsoft. But they're gaining market share and they're investing heavily in this division. They also announced an additional $50 billion stock buyback. And this has been a great investment for us over about 6 years, almost exactly 6 years we've held it. It's up 250% or so. And it's still reasonably valued, I should say, 23 times earnings and projected 20 to 25% growth for the foreseeable future.
34% growth. I mean,
Yeah,
this is just unstoppable.
it's a bargain.
So Steve, with their capitalisation, you named them as a third rank. Would their capitalisation be the third rank as well?
You mean their market cap versus, what are they, about $1.5 trillion?
Okay, so Apple's 2.25 trillion. Microsoft is 1.5 trillion.
Yeah. Alphabet's about 1.5.
Alphabet, I get mixed up on because it has A and B.
About 1.8, I think.
About 1.8.
And Amazon's about 1.7.
About
But
1.7.
these are just the cloud division that we're talking about. So the other businesses they're in are quite disparate. But just for contrast, Alphabet's cloud division is catching up to Amazon and Microsoft. Amazon grew at 32% this quarter, so versus 46, and I can't recall Microsoft, I think 38%.
It's also how they classify it. I mean, suddenly they could just say, "Oh, you're now in our cloud division, right?" So you can grow it by taking from another division too. And so a lot of those have a restructured. But
Yeah.
I mean, I think the really telling thing about Amazon is that their corporate strategy was we make no money, we sell at cost, like Costco. And then Costco makes their profit out of membership fees. But Amazon, they'll never make any money. It was impossible for them not to make money out of Amazon Web Services. So AWS was like generating all this gigantic profits, and it became totally obvious that this was a business to get into. Amazon was the first, but they couldn't not make profit. And it's very, very profitable business.
Very profitable and a growing part of their sales, as it is at Alphabet.
And you build a discrete box out in Werribee with a bunch of servers in it, and you're filling it up with Intel chips, or these boxes are all over the place, these data centers. And they're discrete.
Is a like outsourced for each of those categories out? No. So you can't tell the difference between the $1,000 and no, they're not that transparent. They're becoming more transparent, and we would expect more specifics of each division as we move forward. But they only recently started disclosing their YouTube sales and the growth in YouTube. This is something new within the last 3 quarters.
Investors are pushing for granularity. They're pushing for the info on where the money's coming from. And they're being pushed to provide more and more information each quarter.
That's right, yes. But an enormously profitable business. They made $18 billion this quarter. And if you compare that to the most profitable company in the world ever, Apple made $23 billion in the first quarter. So while these things represent a very large component of the overall index, their earnings are also outsized. And there's real profit backing these valuations. So if you carve out, it's about 150 billion in cash. So call it 20.
You take the
21.
P by about, I thought you did this math and you take the P down to 7% to adjust the cash.
Yeah.
And the debt. So they've got,
Net cash.
they've got net cash.
Yeah, so call it 21, 22.
The reason they have debt is because they might want to use the money in the US, but to repatriate it, there's tax. So they borrow in Europe and then so it's
Well, right now, these money is free essentially, and so it just makes sense to manage your balance sheet with a certain amount of leverage. I wouldn't say they're over leveraged by any means.
no, it's just a net cash.
Yeah.
We got 4 minutes.
Okay, so we'll run through Qualcomm quickly. Again, excellent results, 54% or 52% sales growth in the quarter. They also guided much better than anticipated. We saw, can you click through that, Kelly?
Maybe you want to press the down arrow button on the people.
This is really a 5G story. The rollout of 5G is underway. 5G capable phones are really what drove sales for Qualcomm in the first quarter. They earned $1.90 per share versus $1.67. And there was the announcement that the Federal Trade Commission, which had been pursuing, well, had been suing Qualcomm for the last 5 years in an antitrust suit, they dropped that after a favorable court win for Qualcomm. So that antitrust potential issue overhang is now behind them. They're trading at less than 16 times earnings, 15.8 times earnings. I think it's great value in the tech sector.
Let me just say, I told you so. I told you that China would test Biden's metal on Taiwan, and it is heating up, but Biden will not let Taiwan go to China.
Yeah. And Qualcomm has benefited from the fact that Huawei has been shut out of most developed world markets in the 5G infrastructure rollout. I might hand it to Chris.
Yes. So first quarter results at Boeing were consistent with management's guidance for 21 to be an inflection point. The disappointing aspect was the cash burn, 3.7 billion, and I think a good part of it comes down to timing. They had some manufacturing flaws with the 787 Dreamliner, not to be confused with the 737, which was grounded prior to COVID, and that is notably back in the air since December without issue. And they also had a spat with supplier related to the military contract. So that crimped cash flow, but they're excited for it to be improved through the year. And I think really there's nothing in the result that detracts from our investment thesis. It's a recovery story. Boeing's trading at about 10 times our estimation of normalized earnings of about $25 a share. The underlying drivers of the business are improving. Commercial air travel is resuming, mainly domestically for now. The customers are contributing to a growing backlog that is now exceeds cancellations. Prior to COVID, they had commercial revenues of about 70 billion and about 30 billion from the government. Their total backlog now is about 280 billion. So it represents many years of revenue and cash flow. So the thesis is very much intact. It's going to be an ugly year, but they have the liquidity and the strength in the end markets to ride it out. I'll hand over to you, Joe.
We're at time. So let me just say that we are getting a big increase in plastic and polyurethane and lumber prices. So we're seeing not only a reopening trade, but a reflation trade. UPS is a great company. And as say chemicals and paper and wood and paper are doing very well. And the stocks that we're recommending through Goldman Sachs, Coca-Cola is doing well. Viacom, as you know, up and down on liquidity. Did you, what's going on here? Did you, did we just lose? Oh, everything? Okay, there we go. Electronic Arts, it might be getting towards evaluation. I would be surprised if these companies existed in another 5 years. I think that Sony and Microsoft and Apple will take over these gaming companies. They've got so much money that they don't know what to do with. Buying Electronic Arts Take-Two and then putting them out through an agnostic platform makes a lot of sense. So I think they got to get taken over. Amgen and Medtronic, Alphabet, Qualcomm, Boeing, and a couple of supplementals. We're still in Baidu and Alibaba, so we call that the FANG, so the Chinese. So the world is really becoming East versus West, and the bats you want to own. China's not going away. You want to own them. Don't be whatever. Just the bats are a good place to go, right? Intensive. So the bats and the fangs are important. So thank you. We're happy to continue to answer questions, but we know that it's time, and so we want to also respect your right to go. So thank you, everyone. Oh, and we've got some coffee cups here. We don't know what to do with them. I think that the recommended thing is to put coffee in them.
And they're a good cup to drink out.
And you can drink out of them. Yeah. So please take coffee. Thank you for coming. And we're open 24 hours. You know that, right? So if you don't know that. I mean, the logo is an eagle because that night we were in the father-son group, and we were called Indian. So we used to say, you can't fly with the eagles in the morning, you hoot with the owls all night. Because his name was Hooting Owl when I was flying eagle. And but we do have an owl here all night. We have somebody who works a night desk with we have during market hours. Right? So you can fly with the eagles if you hoot with the owls all night, as long as it's not me. So thank you.